Hi, today's topic is why Ebits and Ebitdas are misleading. Also concepts such as vendors' discretionary income, Addbacks and WACC, or weighted average cost of capital, and why they are based on old concepts and have cost buyers millions of dollars of wasted money in the past. Never trust a report based on them. In fact, if you have suffered loss, consider legal action. Anyone who uses them in their reports simply does not understand about business valuation or markets. Let me show you why. EBITs are earnings before interest and tax, and Ebitdas are earnings before interest, tax, depreciation and amortization. But these concepts are only one part of the equation. The other part is the most worrying, and that is the one concerning the multiple that is used to determine value. Valuations must be based on market activity and provable numbers. If you cannot prove what's in your report and have knowledge about the content, you are fooling yourself and the instructing parties. Now, before we go any further, I wish to state there are two very different markets out there. One, public companies, which are less than 0.01%, of which we will ignore mostly. However, this methodology will work just as effectively on both. Then private enterprises, made up of private companies, partnerships, sole traders, etc., which make up the other 99.9%. It is this sector of the market that I'll be commenting on mostly. So let's return to Ebits and Ebitdas and the multiple that is used and where they come from. Firstly, let me state categorically that the multiplier does not come from market sources, even though they claim so. So how do they get it? This is what they claim. They choose a multiple that they claim comes from industry averages, yet their report shows no other sales activity or comparisons that support the number they use. Generally, for most small businesses, they use a multiple of 2 to 2.5 times. Yet the stupidity does not stop there. For public companies, they use very high multiples and they even publish them. But again, they have nothing to do with market activity whatsoever. Markets move all the time, but their multiples have stayed the same for decades. Explain that. Now they have come up with a new idea that is so crazy, I am dumbfounded as to why no solicitor has ever challenged it before. They now say there are two multiples to choose from, and the implication is that there are two market values. What utter bunkum. They say one is high and the other is low. But get this, they cite the low multiple at 2.04 and the high one at 2.53 and settle for somewhere in between as if this would improve their valuation. Both of these are rubbish numbers and should be challenged any time they appear. Why? Because I have never been able to find these finite numbers anywhere in the marketplace of 45 years of activity. And there is nothing in their report that can support the selection of these numbers. In other words, they cannot prove them. So in order to disprove their report, insist on evidence as to where they got these numbers. Valuers are prevented from averaging, yet people who are not valuers seem to do it every day. Next, they adjust net profits to a level that is beyond comprehension. In other words, they add back all vendors' discretionary income and make EBITs or EBITDA figures as high as they can. And again, this has nothing to do with markets. They are manufactured numbers. In fact, if this is in their report, it's a sure sign that their report is not based on market activity whatsoever. And why? because none of this information is available in the marketplace. Please see my video on business valuation methodologies. Now, a case study. In Adelaide, some time ago, pursuant to court proceedings, an accountant valued a business based on Ebitdas and relied purely on financial documents and cited 2 multiples and simply chose the higher with the usual disclaimers. They had not inspected the business, nor had they read the lease, nor did they know anything about the competition. But get this, they found some money in a separate account and added it to the value of the business. Now let me ask you this question. Would any sane person take money from an account and give it to the purchaser? No, it's pure stupidity. But the solicitors bought it. In fact, this type of report has been fooling solicitors for decades. Also, this old system of valuation does not separate the tangible and intangible assets. They are not the same and must be valued separately. So where have the tangible assets gone? Businesses that have a high percentage of plant and equipment cannot be valued using this methodology. Now, there are many other shortcomings in their report. Basically, no inspection of the subject business, no pictures, descriptions, no inspection of other comparable businesses in their report or the collection of market data, no classification of revenue streams, whether personal, locational, transferable or combinational, no profiling to discover key personnel recognition, no lease detail contained in their report, no fixed cost detail, nor have they compared rental rates of other properties. In fact, they have probably never read the lease, and you will be able to prove this. Valuers should only use numbers they can prove. If you can't prove them, don't use them. All the numbers required to complete a business valuation can be found in the marketplace. Now, having said that, most simply compare selling price and very little other. This is where the gap between valuers opens widely. You must gather more than just sales information. You must compare age of premises, location, area, rentals, rent term, competition numbers, staff numbers, business age and tenure information, previous sale information, and demographics, and the 4 locational type businesses. You must be able to explain what variable or variables caused or was likely to have caused high and low sales in the marketplace. Using turnover is provable, and finding the multiplier from transacted sales is highly provable compared to guesswork or hearsay. In fact, this methodology is market-based and capable of translation into balance sheets that satisfies the asset recognition criteria of the Australian accounting standards. That would assist accounting and financial markets greatly. The definition of an asset, according to the accounting industry, is, and I quote, "It must be definable and capable of reliable measurement and have future economic benefits." Let's consider just one scenario to show how incorrect their methodology is. Business A and Business B both have the same turnover, $1 million, and the same net profits, EBITs or Ebitdas. Now remember, no one can know where they got their EBIT, so we'll use net profits at 200K. And we will use their high multiplier 2.5 times. If we did this, we would produce a value for both businesses of 200 times 2.5 or 500K. Now I asked you this question. Which business do you think is more valuable? Someone has just lost 500,000K based on this advice. Regardless of revenue achieved, if revenue comes from a related party, say family, government or single source, this goes to the question of transferability of revenue streams. If the revenue streams can't be transferred or is highly risky, what happens to its value? It diminishes or disappears. So which business do you think is more valuable? I hope they have their P&I insurance paid up. The next scenario, key personnel. Let's say you're about to buy a business with 1 million turnover and you discover that there is one person that will not be going with the business. What do you do? In the case study discussed earlier, one of the parties had all the knowledge of the business in their head, so it could not be transferred. If the revenue streams cannot be transferred, then they attract no commercial value. This is a clear indication of who owns the revenue streams and where the intangible asset value comes from. The revenue streams attract value, but if they are owned or controlled by another, they are not yours to sell. Therefore, from a purchaser's point of view, you should only pay for what you get, i.e. turnover of 650k multiplied by the market rate in the dollar. I hope this presentation will put you on the right path, and the subject matter is all contained in my book. I hope you'll get your copy soon. It will assist you to make better decisions. That concludes today's presentation. Thank you for watching.